Let's talk about crypto. We all know it's a wild ride, right? Fortunes can be made and lost in the blink of an eye. So the real question is, how do you navigate that chaos without getting wiped out? Well, today we're going to zero in on two absolutely essential survival tools, the simple but powerful stop loss and the more advanced strategy of hedging. Let's dive in.
First, I want you to look at this number, $19.3 billion. That's not a typo. In a single, insane 24-hour period, that's how much money in leveraged crypto positions just vanished, forcibly liquidated. I mean, to put that into perspective, that was 9 times the previous record. This wasn't just a market dip, this was a complete bloodbath.
And this wasn't just Wall Street giants. That one event slammed 1.6 million everyday individual traders. Just think about that for a second. That's 1.6 million people who watched their capital get erased. It's a brutal reminder of what happens when insane volatility meets unchecked risk.
You know, a market observer on Reddit just nailed it with this quote. When retail traders pile on extreme leverage, they stop being investors and they become the fuel for bigger predatory players. Their liquidation points literally become targets on a map. So how do you make sure you're not the fuel?
So here's our game plan. We'll start by looking at what really happened during that crypto wipeout. Then we'll talk about your number one line of defense, the stop loss. After that, we'll get into the more advanced stuff, hedging, and 3 ways you can do it. And we'll wrap it all up with what might be the most important piece of the puzzle, discipline and having a solid plan.
So what actually caused that massive firestorm? It was a textbook liquidation cascade. You see, it all starts with a sudden shock to the system. In this case, some big geopolitical news. The price takes a hit, right? And that triggers the first round of liquidations for all the over-leveraged traders. Their forced selling floods the market, which pushes the price down even more, which, you guessed it, triggers the next wave of liquidations. It's a vicious domino effect that just feeds on itself.
All right, to make sure you don't get swept up in a cascade like that, you need a defense. And your most basic, absolutely non-negotiable tool is the stop-loss order. Just think of it as your emergency eject button before the plane goes down.
So what is it? A stop loss is simply an instruction you give your exchange to sell your crypto if it falls to a certain price. And the magic word here is automatically. You decide on your get me out of here price when you're calm and rational, and the system executes it for you, no questions asked. No emotion, no hesitation.
Let's make this super practical. Say you buy Bitcoin at $30,000. You decide right then and there that the most you're willing to lose is 10%. So you immediately set your stop-loss order at $27,000. Now, if the market tanks and the price hits 27K, poof, your Bitcoin is sold automatically. Yeah, you took a 10% loss, but you just saved yourself from a catastrophic 30, 40, or even 50% loss. Huge difference.
And this really highlights 3 massive benefits. First, the obvious one. It puts a hard cap on your losses. Second, and is so important, it yanks emotion right out of the driver's seat. You're not sitting there sweating, hoping it'll bounce back. The decision was already made with a clear head. And third, you can really think of it as a free insurance policy. It costs you nothing to set up, and you only pay a tiny transaction fee if it actually gets triggered. Okay, so a stop loss is your eject button. It gets you out of a bad situation. But what if you're a long-term believer in an asset and you don't want to sell? You just want to protect yourself from a temporary storm. Well, that's where we get into a more sophisticated strategy, hedging. At its core, hedging is basically like buying insurance for your portfolio. Instead of just ditching your asset when the price drops, you open up a second opposing position. The whole idea is that the profit from that second position will cancel out or offset the loss on your original investment. So let's be crystal clear on the difference here, because it's important. A stop loss is an exit strategy. Its job is to close your position and stop the bleeding. Hedging, on the other hand, is an offset strategy. It keeps your original position open, but uses a second trade to neutralize the potential losses. One is about getting out, the other is about staying in, but with protection.
Okay, so how does this actually work in the real world? There are a few ways to hedge in crypto, but let's break down 3 of the most popular strategies you'll find in any serious trader's toolkit.
First up, we've got futures contracts. So let's say you're holding a bunch of Bitcoin, but you've got a bad feeling about the next month. You can sell or short a Bitcoin futures contract. If you're right and the price of Bitcoin does fall, sure, your Bitcoin holdings will lose value, but the profit you make on that short futures contract can help cancel out that loss.
Strategy number 2 is using options, specifically buying something called a put option. Now, this is the closest you'll get to a traditional insurance policy. You pay a little bit of money up front, that's called the premium, for the right, but not the requirement, to sell your asset at a guaranteed price. So if the market price falls off a cliff way below your guaranteed price, your put option becomes way more valuable, and that profit helps cushion the blow to your main holdings.
And our third strategy is probably the most straightforward of them all, just using stablecoins. Look, if you feel like the whole market is about to take a nosedive, you can simply sell your volatile stuff, your Bitcoin, your Ethereum, and park your money in a stablecoin like USDC. You're basically taking your chips off the table and moving to a safe haven that's pegged to the dollar. You protect your capital, wait for the storm to pass, and then you can decide when it's safe to jump back in.
So we've just covered some really powerful tools. But, and this is a big but, it is so important to remember that none of these are magic bullets. A stop loss, a hedge, they're only as good as the plan you have and the discipline of the person using them.
So if there's one thing to take away from all this, it's this. Success in these crazy markets isn't about chasing moonshots. It's about being ruthless when it comes to managing your risk. Whether you're using a basic stop loss or a fancy hedging strategy, it has to be part of a plan you made ahead of time. The second you let fear or greed take over, you've abandoned your strategy, and that's when you become vulnerable. Proactive risk management is what separates the long-term survivors from the liquidation stats.
And that really just leaves one final question for you to think about. After hearing all this, which one are you going to be? Are you going to be an investor who defines your risk and sticks to a plan, or are you just going to be more fuel for the next big market fire? The choice, really, is all yours.